Hey everyone, welcome back to Corporate Decoder, the place where we unpack the biggest financial stories in the most digestible way possible. Today we're diving into Fidelity CONCORD Street Trust's latest filing. And let me tell you, it's a deep dive into the world of index funds packed with tables and numbers that paint a pretty clear picture of where things stand for their Nasdaq Composite Index Fund. Before we get started, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. It's a great place to connect and discuss these filings further. Let's get straight into it. This report gives us a look at the fund's status as of May 31, 2025. It's a semi-annual shareholder report, so it covers a 6-month period. This report focuses on the Fidelity Nasdaq Composite Index Fund, a fund that aims to track the performance of the Nasdaq Composite Index. Essentially, it buys the same amounts. One of the first big numbers we see is the fund size, which stands at a massive $18,476. That's a huge amount of money managed by this fund. It tells us this is a popular investment choice for many people. Now, when you're tracking an index like the Nasdaq Composite, you're going to have a lot of investments. This fund has 2,719 holdings. That means it owns small pieces of a vast number of companies. This wide diversification is a key part of how index funds work to spread out risk. The portfolio turnover is 5%. That's a very low number, which is typical for an index fund. It means they aren't buying and selling stocks very often. They mostly just hold them to match the index, unlike actively managed funds that try to pick stocks they think will do well. Index funds just mirror what's already in the index. When we look at what the fund invests in by market sector, we see a heavy concentration in information technology. It makes up 49.4% of the fund's net assets. This tells us the fund is heavily influenced by the performance of big tech companies. Then communication services takes up 15.1% and consumer discretionary is at 14.9%. These top three sectors alone account for about 80% of the fund's investments. This concentration is a direct reflection of the Nasdaq Composite Index itself, which is heavily weighted towards these growth-oriented sectors. Healthcare, industrials, financials, consumers, a direct reflection of the Nasdaq Composite Index itself, which is heavily weighted towards these growth-oriented sectors. Healthcare, industrials, financials, consumer staples, utilities, materials, real estate, and energy make up the rest, with energy being the smallest at just 0.5%. The fund is almost entirely invested in common stocks, with 99.9% of its net assets in them. That leaves just 0.1% in short-term investments and net other assets liabilities. This confirms it's a stock-heavy fund aiming for growth through equities. Geographically, the fund is overwhelmingly invested in the United States, with 96.2% of its assets located here. Canada is the next largest at 1.0%, followed by China at 0.7%. All other countries represent very small portions of the portfolio. This strong US focus means the fund's performance is very closely tied to the health of the US economy and its stock market. Now let's look at the specific companies this fund invests in. The top holdings are dominated by giants. Microsoft Corp holds 11.0% of the fund. Nvidia Corp is right behind with 10.6%. Apple Inc. has 9.6%. Amazon.com Inc. is at 7.0%. Meta Platforms Inc. Class A makes up 4.5%. Broadcom Inc. and Tesla Inc. are also significant holdings. These top 7 companies alone account for over 60% of the fund's total assets. This level of concentration in a few large companies means their performance has a major impact on the fund's overall returns. If these companies do well, the fund does well, and if they struggle, the fund likely will too. This is a crucial point for anyone investing in this fund. Scrolling down to the schedule of investments, we see a massive breakdown of all the fund's holdings. It's a testament to the sheer number of companies in the Nasdaq Composite Index that this fund tracks. For example, among the top holdings, we see Microsoft Corp here, valued at $2,013,039,584. And Nvidia Corp, valued at $1,939,248,603. Apple Inc. is valued at $1,774,597,121. Amazon.com Inc. stake is worth $1,277,908,719. Meta Platforms Inc. Class A is valued at $80,34,042,229. Moving over to the statement of assets and liabilities, we get a snapshot of the fund's financial position. The total investment in securities is listed at $18,965,030,584. This matches the fund size we saw earlier and confirms the value of all the stocks and other investments the fund holds. The net assets of the fund are $18,473,815,096. This is the value of the fund after accounting for all its liabilities, and the net asset value per share, which is essentially the price of one share of the fund, is $2042.84. This is what an investor would pay to buy or receive when they sell a share. Now, let's look at the statement of operations, which tells us about the fund's income and expenses over the last 6 months. The fund generated a total income of $77,961,980. This income primarily comes from dividends paid by the companies it invests in. On the expense side, after reductions, the fund spent $26,337,991. This covers things like management fees, custodian fees, and other administrative costs. The fact that expenses are reduced indicates that the investment advisor is covering some costs, which is good for investors. This resulted in a net investment income of $51,623,989 for the 6-month period. However, when we look at realized gains and losses on investments, the fund had a net realized loss of $6,171,224. This means they sold some investments for less than they bought them. And more significantly, there was a large change in unrealized appreciation or depreciation, with a total change of negative $112,495,869. This reflects the decrease in the market value of the fund's investments that were still held at the end of the period due to market fluctuations. Putting it all together, the fund experienced an overall net loss of $1,118,667,093 for the 6-month period. This means that despite the dividend income, the drop in stock prices during this period led to a decrease in the fund's overall value. This resulted in a net decrease in net assets from operations of $67,043,104. Essentially, the fund's investments lost value during this reporting period. The statement of changes in net assets shows how the fund's total net assets changed over time. It highlights that the fund experienced a net decrease in net assets from share transactions of $53,500,879. This means that more money was redeemed by shareholders selling their shares than was invested by new shareholders buying shares during this period. Overall, the fund saw a total decrease in net assets of $234,315,026 during the 6 months. This is primarily due to the net loss from operations earlier discussed and the net outflow of cash from shareholders redeeming their shares. Now, for the financial highlights, which give us a per share view of the fund's performance. At the beginning of this 6-month period, the net asset value per share was $244.91. And at the end of the period, it was $2042.84. That's a decrease of about 83 cents per share, confirming the overall loss experienced during this time. The total return for this 6-month period was negative 0.27%. This means if you invested $100 in this fund at the start of the period, you would have had about $99.73 at the end. The little H next to it indicates this is annualized. Next to it indicates this is annualized. Now, looking at the expense ratios, the expenses before reductions were 0.29% annualized. This is the underlying cost of running the fund. And importantly, the expenses net of all reductions remained at 0.29%. This means that despite the advisor's agreement to reimburse expenses, the actual cost to the shareholder didn't go down. They're paying that 0.29% regardless. The net investment income as a ratio to average net assets was 0.57% annualized. A positive number here suggests the fund's income from investments was greater than its operating expenses. But as we saw in the statement of operations, this was more than offset by market losses. The portfolio turnover rate of 5% is consistent with our earlier observation that this is an index fund that doesn't trade frequently. The notes to financial statements provide more in-depth explanations of the accounting policies. Under the investment valuation policy, it explains how they value their holdings. Most investments, like common stocks traded on major exchanges, are valued based on readily available quoted prices. These are categorized as level 3. The breakdown of these valuation inputs shows that almost all of the fund's investments, a staggering $18,965,801, are categorized as level 1. This means they are valued using quoted prices in active markets. They're very small amounts in level 2 and level 3 inputs, indicating the fund primarily holds highly liquid, publicly traded securities. The fund uses derivatives, specifically futures contracts. As of May 31, 2025, they had futures contracts with a value of $5,771,734, all on the asset side, meaning they were in a positive position on these contracts. This is a small portion of the overall fund value used likely for managing market exposure. Let's revisit the statement of operations for a moment. The management fee here is $26,341. and $873 is the direct cost paid to Fidelity Management and Research Company LLC for managing the fund. Given the fund's size, this fee is substantial. And finally, we have the board approval of investment advisory contracts and management fees. This section details the annual review process where the board of trustees decides whether to renew the contracts with Fidelity Management and Research Company LLC and Geode Capital Management LLC. They considered the nature, extent, and quality of services, the competitiveness of fees, the profitability for Fidelity, and economies of scale. The report mentions that the fund's management fee and total expense ratio ranked above the competitive median in peer groups. However, it also notes that when compared to funds tracking the Nasdaq 100 specifically, this fund is priced lower. Fidelity is also contractually agreeing to reimburse expenses to keep the total operating expenses at 0.29% through March 2026, which, as we saw, didn't result in a lower expense ratio this period but is a form of protection for investors. This fund is priced lower. Fidelity is also contractually agreeing to reimburse expenses to keep the total operating expenses at 0.29% through March 2026, which, as we saw, didn't result in a lower expense ratio this period, but is a form of protection for investors. Now, looking at these results more broadly, this fund, like most index funds tracking a major tech-heavy index like the Nasdaq Composite, is very sensitive to the performance of large technology companies. The report shows a significant concentration in top holdings like Microsoft, Nvidia, and Apple. While this can lead to strong returns when these companies perform well, as they have in many periods, it also means the fund is exposed to considerable risk if these companies stumble. The negative net return for this 6-month period highlights that risk. The low portfolio turnover and minimal use of complex derivatives suggest a strategy focused purely on tracking the index with minimal active management intervention. A notable risk here is the heavy reliance on a few mega cap tech stocks. Any significant downturn in these specific companies will directly impact the fund's performance. An opportunity for this fund lies in its ability to provide a simple, low-cost way for investors to gain exposure to the growth potential of the Nasdaq Composite Index, assuming that index performs well over the long term. The fact that the board renewed the advisory contract suggests continued confidence in Fidelity's management and Geode's sub-advisory services despite the recent performance dip. In conclusion, this filing paints a picture of a large, stable index fund heavily invested in the US tech sector. It delivered a negative return over this 6-month period due to market conditions, but maintains its core strategy of tracking the Nasdaq Composite with low turnover and minimal expenses after reimbursements. The concentration in top tech names is both its strength and its main risk. Alright, that's our breakdown of Fidelity CONCORD Street Trust's latest filing for the Nasdaq Composite Index Fund. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.